We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gary Savage. He's a retired entrepreneur, stock and commodity trader, and founder of the Smart Money Tracker Premium.com. Thanks for joining me today, Gary.
Hey, thanks for having me on, Tom.
So, Gary, I thought we could start by talking today a little bit how liquidity moves through the system. Even though we keep getting good jobs report numbers, and that is, really relied upon to show that we're not in recession and that we need to keep raising rates as we're still above the 2% inflation target as well. Is it possible that the summer rally in the stock market was driven by the liquidity that was given to the banks to keep them from collapsing this spring?
I think that's exactly what drove it. You can, if you look at a chart, you'll see that the banks bottomed, I think it was early May, and that's right about the time that the NASDAQ took off. So that liquidity, while it kind of propped the banks up and prevented them from, crashing further, and they have rallied a bit, but they're not out of the woods by any means. So I think a lot of the liquidity maybe was pushed into the banking sector, the banking stocks to begin with, but it kind of leaked out into the tech sector quite a bit, and I think that's what gave us that almost parabolic type move in the Nasdaq, which I think is kind of at risk right now. The price is stretched way too far above the 200-day moving average, especially in the Nasdaq, the tech or the semiconductors, and even the S&P as well. So, and we're in the timing band for an intermediate decline. So, the stock market is at risk of a significant decline here. Now, I don't know whether they can pump some more liquidity in there, turn the dollar back down, maybe hold it off for another month or two, or not. But we're in the timing band for it.
So, as we're kind of thinking about, let's say, how that worked and that mechanism at that time, what does the banking system kind of look like to you? Or do you think we're starting to see part two of the banking problems that were caused by the Fed, or that caused the Fed to open up the BTFP facility in the first place?
We will. The banking stocks, like I said, they've rallied a bit, but they're not out of the hot water yet. They're still too close to those all-time or those recent lows, the May lows. And when the stock market rolls over and gives us an intermediate decline, which it may have already started, it's going to drag those banks down too. And I think there's probably a pretty good chance that the banks can make lower lows. I think that's going to cause the Fed to panic again, and they'll print more liquidity. And the problem they've got now is that not only did a lot of that liquidity go into the tech sector, but recently it started to go back into the commodity sector. And I'm pretty confident that the CRB has completed its 3-year cycle low in June. And now we're starting to see in energy. So oil in particular has really started to go a lot higher. So I think that liquidity that was intended for the banks leaked into the tech sector, and the general stock market is now starting to leak into the commodity sector, especially energy. And we're probably starting the second phase of the inflation cycle. So the first phase ended, of course, when Russia invaded Ukraine, and then we had a pause, which is completely normal. You'll get some kind of a pullback between the first and second phase, but I think that liquidity is starting to go back into the commodity sector and the energy sector, and if we do get a hard move down in stocks and the banks take a beating, the Fed's going to be forced to print even more. And they've already got a problem because that liquidity is already starting to go into commodities, so it'll just probably go. They'll probably create another really bad inflationary phase, and that generally is what causes a recession. Is when inflation gets out of control, then it collapses the economy, and you have a recession.
Mm-hmm. Yeah, it seems like they're really stuck between a rock and a hard place here, because if we get a stock market crash, even just looking at these charts, how far they are stretched above their 200-day moving average, just that reversion to the mean could be a fairly spectacular move. But if they have that combined with, let's say part two of any type of a banking crisis, you would think that they would want to come in and save that. But if we combine that with this inflationary backdrop, as you're pointing out, energy, it really kind of puts them in a place that they really don't want to be, because they want to continue this valiant inflation fight, right?
Yeah.
Yet have this stock market collapse on the other side, and possible banking collapse.
There is no free lunch in the world, so that they're finding out that right now they print a lot of money to try and stop the banking collapse, but it's having consequences. And the first consequence was good. Everybody likes stock market going up, but the second consequence that's starting now is that all that liquidity is starting to ignite the second phase of inflation. So there just is no free lunch. You've either got to let the banks collapse and let everything collapse, or if you try and save the banks, you're going to have an inflation.
Mm-hmm. Do you think we get that inflation either way, Gary?
Well, I don't think they're going to allow deflation.
Mm-hmm.
I don't think they're going to allow the banks to collapse. So I think it's inevitable. We're going to, if they were to allow a deflationary collapse and allow the country to go into what I think would be a really hard recession, then yes, the commodity markets would go down with it. But I just don't think they're going to allow that. I think they're going to pause at the next meeting. And I think the futures are kind of pricing in a pause for the rest of the year. It's not showing any of the upcoming meetings having a very high odds of another rate hike. So I think they've already decided that they're going to pause, and it's just going to make the inflation worse. I just don't think they're going to have the guts to keep hiking and force a recession.
So when we think about, let's say, where that liquidity went to, the NASDAQ and the S&P to some extent, the first time, when the banks were bailed out, is there a particular reason that you think that this is going to move into the commodity complex this time? Is it because of this momentum and some of that air coming out of the stock market versus this upward trajectory of energy and commodities?
Well, some of it's just that liquidity over time tends to move from overvalued assets to undervalued assets. And we put in the bottom of the bear market in commodities back in March of 2020. That was where oil went to minus whatever it was, $35. That was the bell ringing that the bear market in commodities was over. And then we started the first leg up in an inflationary environment, and that took oil from minus 35 to whatever it was, $135, I think, something like that, at that top in March when Russia invaded Ukraine. And so this is not done. The stock market is still massively overvalued, and commodities are still severely undervalued. So liquidity is going to continue to move from that overvalued asset to the undervalued asset. The Fed will try and fight this. They'll try and suppress gold and the metals and things like that, but they're not going to succeed because we've completed that 3-year cycle low. So, metals are, notorious for bank manipulation. And I think I've gone over this with you before. I think the reason they do that is gold is the canary in the coal mine. If gold gets out of control, it's a clear red flag that you got an inflation problem, you got problems. And so it's basically impossible to try and keep all the commodities suppressed, but you can try and keep gold and silver and those markets suppressed and hope that the rest of the markets commodity markets kind of stay in check. And a lot of the time that works, but it's kind of stopped working. And now that we're in the advancing phase of a new 3-year cycle for commodities for the CRB, and we're also in the advancing phase of a new 8-year cycle in gold, they're going to have less and less success suppressing the metals and keeping commodities under control. And the more they do this, the more violent and the bigger the rally is going to be when the manipulation breaks, and it will, because we are in that advancing phase of those cycles now. So it's going to be less and less successful, all of these attempts to keep the commodity markets in check.
Gary, if we kind of contrast the idea between being able to manipulate the gold and silver markets versus something like oil, let's say, can we think about the difference there, as oil is a much bigger market that has more liquidity, more flows, and is traded more throughout the world, versus gold not being as big of a market and has types of mechanisms built into it that are more easily manipulatable?
Gold is definitely a much smaller market than energy, and it's not just oil. You've got all the commodities, the grains, and everything. So, like I said, it's impossible to try and suppress all of those markets, but you can suppress the gold market, which is small enough that it can be, to some extent, suppressed. Although, realistically, gold has gone from $250 to $2,000, over $2,000. So, yes, they're suppressing it, but they're not stopping it. They're slowing it down, and they're just creating more and more pressure, so that once gold breaks out above those all-time highs at 2090, it's going to be game on at that point. And all they're going to do is make the rally more violent, bigger, and more durable in the long run. So, let's say if gold was naturally going to go to 7,000, all of this suppression is just going to make sure that it goes to 10,000 instead of 7.
So when we think about, let's say, that the structure within the gold chart there, getting above that 2090 high, we've bounced off of it a couple times here. How many times do we need to retest it, do you think, for that all-time high to be able to be broken? Or is that more of, this advancing cycle move, as you say, the start of the 8-year cycle, that is going to give it the strength to be able to break that all-time high?
So one of the rules, and I may have discussed this with you before too, breakouts tend to be sustained when they occur early in a cycle. So in this case, we're looking at the intermediate cycle. So if you want to see a sustained move, then you want a price to break out above some resistance zone early in that intermediate cycle. Then it has plenty of weeks left to continue to rally and get a sustained move before you get an intermediate top and a correction. Breakouts that occur late in an intermediate cycle generally don't produce sustained moves, and this is how traders get caught at tops. You get a breakout. So, for example, I think gold's on either week 5 or 6. If gold gets up to 2090 and we don't get there until like week 15, and then we break out, you're going to catch a bunch of gold bugs buying that breakout too late in that intermediate cycle, and then it's going to pull back again. We really want the breakout to occur by, let's say, week 10. If we get that, then we'll get a sustained move, and then maybe the correction will be to come back down and retest the breakout, but not drop back below it. So that's what I'm watching right now. As of today, there's a chance maybe that gold has completed this daily cycle low. I was pretty convinced that we got an intermediate cycle low about a month ago, and it's just right now gold is dropping into a smaller degree daily cycle low. I expect that daily cycle low to hold above that intermediate bottom. So if we can get some good upward momentum here in the next 2 or 3 weeks and retest that 2090, then I think we have a good chance of breaking out and making a run to 22, 2300 before we get our next intermediate correction that might have to come back down and test that 21 again.
So where are we in that intermediate cycle? Are we just starting it, and that gives us some time and some road to be able to get back to that 2090 level?
So why don't we share the screen here, and I can kind of show the listeners here what I'm looking at. Okay, this is that's a stock market. Let me go to gold here. All right, so let me put the weekly chart up. So this is the weekly chart. This would be our intermediate cycle low here right at the end of June. So we're, let's see, 1, 2, 3, 4, 5, 6. We're 6 weeks into this intermediate cycle, I think. It is possible that this could turn back down and we get a lower low, and then that would kind of reset the cycle count back to 1. But I don't think so. I think this is going to probably hold. And looks like the market just opened. But we're on week 6, so we want to see, it'd be really good if gold can recover by the end of the week and then hold above this 10-week moving average here. And then over the next 3 or 4 weeks, we get back up and test these all-time highs one more time. And that would put us there early enough to where I think we could get a breakout and in a sustained move. But if we, futz around here and, it's like 15 weeks before we get up here and test this again, then I don't think we're going to get a sustained breakout.
So, Gary, would you mind kind of walking us through the 8-year cycle and how that looks to you? Is that associated with that March 2020 low as well for gold?
That was not an 8-year cycle low for gold. Let me see if I can expand this a little bit. All right, so here was our previous 8-year cycle low here at the very end of 2015. And then the March low, which was a 4-year cycle low for stocks and also a 3-year cycle low for the CRB, was not a major 8-year cycle low for gold. That came right here. I am about 99% convinced that this is the 8-year cycle low in gold. We got a marginal
at about 16, 20 there,
something like that. Yeah.
At the end of 2022.
Yeah.
Sorry, I'm just trying to make it a little easier for audio listeners if that's all they're listening to, right?
Yeah. So let's see. It was 1620. So we got a breakdown below this support zone here. It was a false breakdown and then a reversal, and that's about what you would expect at a multi-year cycle low. That's how these will often unfold. You'll get a kind of a manufactured breakdown that gets everybody bearish, everybody's selling, and the smart money buys that breakdown, and then you get a reversal. So pretty confident this is an 8-year cycle low. So we are in the advancing phase of the new 8-year cycle, and this 8-year cycle, we're going to break out above this triple top. Really, very rarely is there a triple top. It almost always gets tested again, and then you're going to get a breakout. So the fourth test of this is probably going to give us our breakout. And once gold breaks out above that 2090 level, there's no more resistance, and it's going to be game on.
Mm-hmm. Is the picture very much the same for silver?
Much different look in silver. It's not testing its all-time highs at 50. Mm-hmm. But I will say that when gold finally breaks out above the 2090 level, silver's probably gonna be testing that $30 resistance and maybe breaking out above that $30 resistance. And once it does, then it's kind of got a fairly clear shot up to 50. It's going to take some more work for silver to break above 50. But when we get the final bubble phase in the metals, I'm on record as saying that $100 silver is going to be a piece of cake. Now, a piece of cake doesn't mean it's going to go there in a straight line. There could be lots of back and forth and lots of gut-wrenching corrections along the way, but it's going to get there. Mm-hmm. And if we just use some some basic ratios. If the average or the let's just say if we just go to 30-1 on the gold silver ratio, which is what we did back in, I think it was 2011 at that top, a 30-1 ratio, if gold goes to 5,000, which is not much of a move really, considering how long we've been in this basing phase, that would put silver at about $150. If gold goes to $7,000, which is still a pretty modest move considering how big this base is, that would put silver at about 230. And if gold goes to 10,000, a 30-1 ratio on silver to gold would be at about $330. So that's probably on the maybe a bit far-fetched. I don't know that it's going to go that high, but I guarantee gold or silver is going to hit $100. And I think between 100 and 200, 250 is probably likely, in my opinion. So silver is probably the most undervalued commodity on the planet right now, and you're getting a chance to buy it really cheap.
So is that associated with the top of this 8-year cycle as well, Gary? And does that give us somewhat of a timeline to see a new top there?
So yeah, I think we'll get the bubble phase in gold during this 8-year cycle. It could come quick back in the late 70s, when it took gold quite a amount of work to break out above that 250 level. But once it did, within like, it was an 8 months to a year, something like that, it went from 250 to 850. So the bubble occurred really quickly after the breakout. Something similar could happen here if we get once we get this breakout. It could be 2 years and we get our bubble phase, and then it's done. And at that point, you got to look somewhere else. Or it could be 6 years into this 8-year cycle. But I do think we're going to get the bubble phase of this gold bull market during this 8-year cycle.
So why is it that we're on such different cycle lengths, let's say, between gold and the CRB, Gary?
Well, it's completely different markets. The CRB is mostly driven by oil, so that's just a completely different market than gold. Is driven by different factors. I will say this though, gold is leading. I know people get frustrated when we're in these corrective periods, but gold is leading this phase of the commodity bull. Energy led the first phase. We had that huge move from minus to 135 points in oil, whereas gold, we bottomed here at a little 14 something or another during that crash, and then gold made a decent move, but then has been stuck going sideways, building out the handle of this cup and handle pattern. Mm-hmm. So gold was the leader during the first phase of the inflation. Oil was the leader. Gold is now leading the second phase of the inflation. The CRB and oil bottomed at the end of June. Gold bottomed right here in October. So it bottomed way ahead of the rest of the commodity markets, and it is leading this phase of the inflation, even though right now we're stuck in a corrective move, but it's going to end here soon.
So, Gary, when we think about, let's say, the dollar here, you said that you think that the top is in for the dollar. Is that tied to a certain cycle length as well?
Yeah, the dollar cycle is a little bit closer to the CRB cycle. They're both like a 3.5 year cycle. I think the dollar has probably completed an intermediate degree, or not an intermediate degree, but I think it's completed a secular bear market top or bull market top. So I think we've started a secular bear market in the dollar. And let me see if I can pull up a chart of that. So the dollar's been in a bull market, secular bull market, since that bottom in I don't know that I can get a long enough chart to show it here, but when was it? 2008, I think, when it bottomed. And it's been in a bull market ever since. And then we get this, as the Fed starts raising interest rates, we get this almost parabolic run in the dollar, and then that tops, and we get what happens with these parabolic moves is they usually go down just about as fast as they go up. First leg down, we got some sideways chop here, but I think the dollar. Well, first off, we're in the declining phase of this 3-year cycle. It's not due to bottom until the middle of next year, so it's got further to go. Pretty sure we're going to break downwards out of this sideways consolidation here, and then when we get our 3-year cycle low, we'll have another rally. I do not think that rally is going to be able to make a higher high, and ultimately, I think we're going to start breaking below these previous 3-year cycle lows, which would indicate that the dollar is in a secular bear market. So I think that's what's happened. I think the dollar topped with this parabolic move, and we're now in a secular bear market that could last 7, 8, 10 years.
Wow. And that obviously provides another tailwind for gold, with that comparative nature of pricing gold in dollars, right?
It does, yeah, and all of the commodities actually, but gold in particular, and currencies are the driver of the metals, along with geopolitical risk. The digital currencies that central banks are contemplating are very worrisome. I think a lot of people are going to become concerned with that and want to diversify out of the banking system if they can, and gold and silver are the logical place to do it. I know a lot of people like Bitcoin. I'm not sure I'm sold on the Bitcoin. I tend to trust gold and silver have about 5,000 years of history, and I tend to trust those a little more, I think. So I think this phase of the inflation is going to be led by gold, and it is leading. And if the dollar's in a secular bear market, then that's just going to add fuel to the fire.
Mm-hmm. Going back to, let's say, talking about a stock market crash, Gary, does that typically mean, a little bit more strength for the dollar when people are unsure of what's happening? They tend to want to get out of whatever asset they have and buy dollars, spiking, like creating more demand for dollars. Does that coincide with another peak up in the dollar yet?
Well, let me shrink this chart a little bit. So the dollar is in an intermediate. I think the currencies are kind of a mess here, but this looks like an intermediate degree rally to me. But I would expect these intermediate rallies to left translate and make lower lows, and so that's what's happened here. That this was an intermediate degree decline in the dollar. This was an intermediate degree rally. Didn't get very far, and then it broke down and started this long sideways consolidation, and then it looks like to me that it completed an intermediate degree bottom with this false breakdown below the support level. So basically, you got a lower low or a lower high. Here's our previous intermediate top, much lower low, and then here was our intermediate low, and you got a lower low. So we're stair stepping down. We're making lower highs and lower lows, and now we're in what appears to be, to me, again, the currencies are really muddied, but this looks like an intermediate degree rally, and it may be topping here, and if that's so, then it's going to come down and it's going to break below this pivot here at some point in the not too distant future, and then continue to stair step down, and the next intermediate cycle low would presumably be considerably lower than this, because this large, we've had this large consolidation, sideways consolidation. When it breaks down in earnest, it should produce quite the move back down, and that'll probably support stocks, but I think it's going to support the commodities more, and gold and silver a lot more. It'll give us that breakout in gold that we're waiting for.
Mhm. Do we not get another low, or let's say an intermediate cycle low in gold and energy as well, along with a sell off of everything? If we do get, a real stock market correction, typically everything sells off in those types of moves.
Sometimes yes, sometimes no. It depends on how severe the stock market correction is.
Mhm.
If you're starting to get massive margin calls, it can infect everything. Um, Although I will say, if we were to get some kind of a mini crash in the stock market here over the next couple of weeks, gold would probably start to sniff out a Fed response to that, and it would probably bottom ahead of the stock market.
Okay.
Oil could definitely get dragged down with the stock market
Mhm.
because people will start to assume, we're going into a recession, which I don't think we are yet.
Mhm.
We will maybe next year, but I don't think it's started yet. But anyway, um, if we do get that, we could have some sympathy selling and everything, but I think gold would bottom ahead of the stock market in anticipation of a Fed response, more liquidity.
Excellent, Gary. Are there any particular markets or, let's say, triggers that you're keeping your eye on that you need to see as confirmation for any of these moves?
So what we're watching right now is the banks. This is what the Fed's trying to protect. This is the Philadelphia Banking Index right here. There's also the KRE as the regional banks.
Mhm.
This is what they don't want this to roll over and make a lower low. So they're gonna pump liquidity into these stocks, into the banking sector, trying to keep this elevated and keep this from crashing. Now, if the stock market gives us an intermediate cycle low, then the banks are going to follow, and they're going to be at risk of dropping below this pivot here. If the stock market gives us some kind of I wouldn't say a crash. I don't think we're going to have an 87 crash, but we are very late in this intermediate cycle. And there is a possibility of maybe a mini crash that could take the stock market down and shrink some of that liquidity. Um, the indexes have just gotten stretched way too far above that 200-day moving average. So that is the risk, is that we could have some kind of a mini crash over the next 2 or 3 weeks, and bring those indexes back down much closer to that 200-day moving average. If that happens, these banking stocks are going to be at risk of breaking below this pivot.
Mhm. Awesome, Gary. Anything else you'd like to add before we wrap up here?
Oh, I think we covered everything.
Yeah, sounds good. Of course, smartmoneytrackerpremium.com, and you're also post free videos on your YouTube channel, Gary Savage, and at Gary Savage 1 on Twitter, right?
Correct.
Perfect. Gary, thanks so much for your update today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.